Good afternoon. Welcome to this webinar. We're glad that you took a little bit of time here this afternoon to join us. Gary and Lyle here to share some things with you about year-end planning considerations. We're going to be looking mostly at things related to taxes and some charitable giving. So Gary's going to be presenting, and I'll be chiming in along the way. But yeah, thanks again for joining us. So hey, take it away, Gary. Thanks.
All right, I think we'll give it maybe another 15 seconds just to let everyone get signed in and settled, and then we'll get going. So as Lyle said, we're going to be focusing today on some of the decisions that we know we're helping a lot of you make here as we come to the end of the year, especially this year. It's unique in a lot of ways, but I think the main takeaway for us is there's really a lot of good things happening. There's a lot of businesses doing really well. The economy here locally in Lancaster's doing extremely well and has bounced back like last spring almost never happened. So of course it did happen, but we're to a point where it feels like we're well past that and are excited that we've been able to recover so quickly from, of course, what was a major and unexpected disruption. So thanks again for joining us today. Those of you who don't know me, I'm Garry North, and I'm excited to be with you here today to share a little bit about some things we think you can be thinking about and give you a little bit of, let's call it inside information, but not really, on how we think about these decisions at Masters and what principles guide these year-end decisions as we walk alongside you, finding ways to optimize your financial life. So with that, let's dive in. I've got a few sections to go through, and I'm just going to stop at each one for questions. Feel free to throw your questions in the chat or in the question section here on the webinar. Lyle's got a few questions that have come in here ahead of time, so we'll go through those at a few different periods throughout the webinar. So what we really are talking about today is how do you create a consistent decision-making framework. And the reason that we think that's so important here at Masters is if we can create a framework for decisions, then when we have decisions that are either time sensitive, as they are at the end of the year, or impactful, they are decisions that have a large or outsized impact on your personal life or your financial life, we want to make sure we've thought through how we're going to filter through the decision-making process. And the reason we need to do that is because we're predisposed to take a fight or flight response to decision-making. That is kind of built within us as human beings. And so what we want to avoid is making purely emotional decisions, so decisions just based on emotion. Obviously, some of the decisions you make should include some emotion, but especially in financial decisions, most of the decisions we want you to make are logic first and then emotion second. And so we want to create a framework that allows you to avoid making decisions that are purely based on an in-the-moment response to what's going on. And so when we think about creating a decision-making framework, we think about first and foremost defining what is most important to you. So that's not what's most important to Gary. That's not what's most important to Lyle, or even to the team at Masters. It's what is most important to you, the client. And that's different for each one of you. And we feel like that's a really important discussion for us to have as advisors with you, our clients, because we want to make sure that all your decisions are aligned with your personal goals and your personal framework for decision making. So the very first step is what's most important to you. And we, of course, can help you work through figuring out and how do you put some meat on the bone of answering that question. Once we've set our framework, we need to make some assumptions. We make a lot of assumptions in financial planning. The team here at Masters is very used to working with assumptions, and we have to make some reasonable assumptions about the future. And again, this comes back to you and your personal situation. We know we spend a lot of time with all of you talking about, hey, what do we expect for the future, for next month, for next year, for your retirement, for the next couple of decades. And we need to do that just so we at least have some frame of reference to work through when we're building a framework for decision making. But after we've made those assumptions, we want to focus on what do we control today? Especially right now, there's a lot of things going on that none of us have control over. And even though sometimes it might feel like we want to spend time thinking about those things and talking about those things with others, it's really not going to get us anywhere. And so what we need to do is break down, okay, what can I control today? No matter what's going on around me, no matter what's going on 2 hours south of us in Washington, D.C., or elsewhere around the country, around the world, what is in my control? And how can I use that to my advantage to continue to work towards what's most important to me? And of course, we have to take action. We can build the most complete decision-making framework possible. We can spend hours and hours thinking and talking about what's most important to us. We can make the best, most accurate assumptions possible. We can clearly define what we have control of. But ultimately, if we don't take action and start moving towards something that's out there in the future, we're just going to be stuck spinning our wheels. And so that's really the basic framework that we think about when it comes to how do you set yourself up for success to make good, balanced decisions, especially when those decisions come under a time constraint like they do here at year end. And so when we wrap this up at Masters, what we think about is putting this together in something that we call the alignment model. That's not original to us. This was another advisor that really came up with this model. And it's pretty simple. And if you think of a funnel, that's really what the alignment model looks like. And at the top of the funnel, we have values. Again, what is most important to you? And again, that's personal to each one of you. What are your goals? What do you want to achieve? That's the second leg of the funnel. And then the bottom of the funnel is actions. What are you doing today? And as your advisors, what we strive to do is make sure that you are consistently living in alignment and what you're doing makes sense for what your goals are, and your goals make sense for what's most important to you. And we want all your financial decisions to flow through this filter of the alignment model. So that's a real brief overview of general decision making. How can we set ourselves up for success, especially when we're coming to year end and we might need to make some quick decisions or we might need to make some consequential decisions. So I'll pause there, Lyle, and see if there's any questions to answer on the overview.
Yeah, Garry, I'm sitting here listening to you. It all seems to make logical sense, but there might be some people out there saying, hey, I've done a pretty good job over the years of just kind of making gut decisions. Like things come on, I kind of have a good sense on if I should go this way or that way. And to spend a lot of time with assumptions, all these things you're talking about, just seems like a lot of hard work. What's the danger of just using gut to make decisions?
Yeah, that's a great question. So I think our gut can be useful because our gut should, to some degree, line up with what's most important to us and what we believe. But if all we do is make gut decisions, the risk we're going to run is, especially with decisions that, again, have some time constraint, we might be filtering through the noise that's around us at the time and not filtering through something that's more eternal for us, such as values, something that's more concrete, such as goals. And so if all we're doing is making a gut call, psychologically what can happen is, okay, if I just talk to somebody, a friend or a colleague who made a similar decision and they went one way, and now I'm faced with that same decision soon after, I might have a bias towards making the type of decision they made because I just heard about it. And that's a psychological term called recency bias. If I'm hearing a lot of noise about what's going on again down in Washington, D.C., I might be predisposed to make a decision based solely on something like that, and maybe it's something out of my control. And so I think the danger there is we open ourselves up to maybe making gut calls based on what we just heard, or based on what we've heard from other people who have different values and different goals, and it's not consistent with what's actually true to us.
Mm-hmm. Yeah, it's good. One of the things that I've experienced that sometimes when we're just making gut decisions all the time is we don't consider unintended consequences. So most financial decisions have a kind of a push and a pull. There's one side to it, but there's something else to consider as well. And when you're just making gut, your emotions might take you to one side of that decision, and you might not have spent a lot of time thinking about, well, what's the consequences? What if it doesn't go the way I wanted to? What could go wrong with this decision? So just another angle on it.
Yeah, I think that's a great point, Lyle. And we're about to dive into the tax piece of things, but there's always two sides to the seesaw, and I think that's especially true on taxes, which again we're going to jump into. But do I want to save taxes today or pay taxes today? Well, there's a lot that we have to balance out to help make that decision.
Yep. Good. I don't see anything else here, Gary, so I think it's fine to move on then.
Great.
Off to taxes.
Awesome. Let's jump into some tax stuff. So again, we want to start with our planning philosophy, and I would say this is really the philosophy we hold to here at Masters. So if you work with us, if you're a client of Masters, you can expect that you're going to hear us help you make decisions within this framework. We're telling you create a decision-making framework, so we better have done that ourselves, right? And so here's some things that we believe about tax planning. First and foremost, good tax planning looks into the future. We think a lot about taxes looking back to the previous year. We don't get our taxes done till 2, 3, 4, maybe 6, 9 months after everything's occurred. And so a lot of the time we're looking back and saying, if I should have done this, I could have done that, if I would have done this other thing. But we really believe, again, we've got to make reasonable assumptions about the future and look forward to help us make decisions today. In that lens, we believe that multi-year tax planning and really helping to vision ahead of what's going to happen a year, 2, 3, 4, 5 years from now, not necessarily in tax policy, but more in your personal financial situation, does introduce a bit more of a complex decision-making framework because there's more factors involved. The further out we go, the more assumptions we have to make. And if we're wrong about those assumptions, the more consequential being wrong is. But we can also create more tax optimization if we take a longer frame of reference. We can help with some tax planning, obviously, just in the year we're in. For instance, this year, 2021, we could say, hey, here's your situation for 2021. Here's what you should do to optimize your tax situation. Certainly, we do plenty of that. But if we can do that in the framework of, here's your tax situation in 2021, here's what we expect your situation to look like with just reasonable assumptions the next few years in the future. And because of that, we can make a more informed decision here today. We also believe the key deliverable for measuring effective tax planning is value added rather than tax compliance. And now there's an assumption in there that either through self-filing or our preference through a good tax CPA or tax preparer, we're kind of assuming that you've got someone who's taking care of what needs to be taken care of on the compliance side. Timely filing your return, putting things in the right boxes, checking the right things, not checking the right things, doing the calculations accurately. I think we would say those are all table stakes. We just expect that to happen. We do a lot of things in collaboration with tax preparers and CPAs to assure that they have all the information they need for the tax compliance piece. But at Masters, we're really focused on where can we add value to your situation through tax planning, rather than being focused on the preparation side, which of course we don't do, but we outsource to a lot of great partners that many of you work with. And then the last piece of this, again, you heard me say it already, but we think clear communication and decision-making in partnership with your tax preparer, with your CPA, is vital to making sure we execute these strategies with a broad enough lens that we're making good decisions. And when we implement any of these strategies, we have to make sure that that implementation carries through to the preparer, to the CPA, so they can execute the compliance piece of that properly. We've certainly seen that in other situations where, you know, clients execute a strategy, but there's been no communication with the tax preparer, and things get missed, things get miscalculated. Of course, the last thing you want is getting a letter from the IRS anytime after April 15th. So we think good communication and collaboration with your tax preparer and CPA is vital to the success of any tax planning strategies we implement. So what are we looking at right now with tax rates? Overall, the tax rates right now that you see in front of you are a pretty good deal historically speaking. They're not the lowest they've ever been. They're certainly not the highest they've ever been. But the Tax Cuts and Jobs Act that went into effect in 2018 did bring tax rates down pretty much across the board. And so we're in a, I would say, better than average tax environment right now. And I provide this to you just so you have a frame of reference for where tax rates are right now, and also remind you how the tax code works. So as you see on this chart, each column has a specific tax rate for a specific range of income. And the way the tax code works in this country is each tax bracket is essentially a bucket. It's a bucket that you fill up with income. And once you fill up that first bucket, in this case, 10% bucket, the next money then overflows into the next bucket, the 12% bucket. And so what you end up doing is you pay this blended tax rate based on how many of those buckets you fill up at different levels. And this is something that I think can get a little bit tricky because it's not necessarily intuitive. And so let me just offer you a very brief example. Let's go to the third row, which is if you file as a married person. And let's just say you make $200,000 a year. That's going to take us down to the fourth row of this chart, which is the 24% tax bracket. What you'll see is you make $200,000 a year and you file married, filing jointly, you're not going to pay 24% on $200,000. You're only going to pay 24% on the dollars between $171,051 and $200,000. That's all you're going to pay 24% on. Then you're going to pay 22% on what you see the third row down on the right column, 80,000, 171,000, and so on and so forth. So even if you say, well, I'm in the 22 or the 24 or the 32% tax bracket, your effective tax rate is going to be lower than that because this is, as they call it, a progressive tax policy environment. And so I just share that as a reminder that the tax code here is maybe a little funky. It's not necessarily intuitive to us all. And what you're seeing here is the brackets for taxable income. What you see at the very bottom are the standard deductions that you can take if you don't itemize your deductions that will be deducted off your gross income to get to a taxable income, which dictates your bracket. So if you make $100,000, you're married filing jointly, and you take the standard deduction of $24,800, that puts you at a taxable income of $75,200, and that would put you in the 12% tax bracket. And so that's how our tax code works. You take your gross income, your adjusted gross income on your tax return, You subtract either the standard deduction you see here, or if you have itemized deductions above that, your itemized deductions, that gets your taxable income, that determines your tax rate. Now, there's also another set of tax rates that matter to a lot of you listening on this call. That's capital gains tax rates. And capital gains tax rates come in two forms, short-term and long-term. If you have short-term capital gains, they're taxed at the same rate as ordinary income in general. But if you have long-term capital gains, and that would be any asset that you held for more than a year, qualifies for long-term capital gains, you actually get a preferential tax rate versus your regular income tax. And that's what you see here. You see the ordinary income tax rate in blue. The left graph is for individual, the right is for married filing jointly. And you see beside it the capital gains rate. And what should really be jumping out at you in this chart is that if you have a taxable income, and these numbers are actually from 2019, so we'll go to 2020 numbers, you have taxable income below roughly $80,000, and part of that money came from long-term capital gains, you pay 0% on those gains. You essentially get those gains for free. And so that is one very real tax planning opportunity, especially if you're retired and you have a lower income and you have non-retirement investment dollars. If we can get those for free at 0%, that's certainly something that we want to look at. And so I just wanted to highlight that we have capital gains rates and you can use them to your advantage, assuming that they're long-term. Now, I want to highlight one other thing here that's a little different, that was changed back when some of the tax updates came through in the Obama administration, and that's this 18.8% rate. If you would look up capital gains tax, you would see three capital gains tax brackets: 0%, 15%, and 20%. The reason you're seeing an 18.8% bracket and a 23.8% bracket here is because the Obama tax policy introduced a new tax on investment income, also called the Medicare surtax, if you've heard of that. That's 3.8%, and that's an additional tax that goes into effect if you're married filing jointly over $250,000 of income. So if you have investment income and you make more than $250,000, anything above that $250,000 line is going to be taxed at 15 or 20% plus another 3.8%. So that's another trigger that we look out for. If you're around that zone and you have investment income, but we could find some deductions to keep your income below $250,000, that could be another tax optimization strategy we might want to look at. So death and taxes, you've all heard the term. I apologize for using a cliche in this presentation, but I think it fits. One way or another, you're going to pay taxes. We know that. It stings a little bit to say it, but one way or another, you're going to pay taxes. And so our strategy says, okay, we're going to pay taxes. So we want to focus on how should we pay them, when should we pay them, and how can we use that to our advantage. And so in general, remember, this is a general philosophy, but it applies in most cases. Our philosophy looks like this, and this is just a simple way to break down how we think about tax planning. If your taxable income today is higher than it will be in the future, we want to look for deductions. Again, this is general philosophy, but in most cases, it's going to apply. So if your taxable income is higher today than it will be in the future, it probably makes sense for you to try to get your taxable income today down. If your taxable income is lower now than it will be in the future, it could make sense to actually increase your taxable income today, because you still would be paying potentially a lower rate today than you might in the future. And then if your taxable income is level now, if it's the same as it's going to be in the future, and I say taxable income, but I would really think about this as, is your tax bracket the same today as it will be in the future? Then other planning opportunities are what should drive your tax strategy. I just touched on one on the last slide, which is, let's say you're retired, you're living on a fixed income, and you're in the 12% tax bracket for income, which means you're in the 0% tax bracket for capital gains. And you expect your income to stay that way for quite some time. If that's the case, then it probably makes sense for us to realize long-term capital gains, pay 0% for as much as we can. So essentially, remember, fill up that bucket, that 12% bucket, so we pay 0% on that. Another thing we could look at there, which again I'll touch on later, is Roth conversions. If you have lower income today than you think you're going to have in the future, it might make sense for you to take your pre-tax IRA, use some of it to convert it over to Roth IRA. Now you've got all that growth tax-free. So when we see level income or level tax brackets, we're looking for other planning opportunities. How can we drive some other planning opportunity? Or in some cases, we might look and say, you know, there's really nothing else here that we should do, and we might not employ any tax strategies. But I think that's a pretty succinct way to summarize what our general philosophy is on tax planning. So, Lyle, I think before I jump into some of these common tax planning strategies, let's stop and see if there's any questions on what we just reviewed.
Yeah, I was just thinking back earlier on, you talked about sort of multi-year planning, and you were kind of touching on a little bit here at the end, but I thought maybe if you could just expand a little bit, like when you're thinking about multi-year, how long out are you typically thinking? How long? And then what are some of the things that you could do? And that's kind of, I think, where we're going to go here with some of these strategies. Might be leading you right into this next slide, but maybe just comment a little bit more about that idea.
Sure. So the time frame is going to be whatever is relevant to the client situation. But really, the picture I have in my head is, what is your taxable income going to look like on a graph? If we would graph out an assumption about your taxable income for the rest of your life, what would it look like? So if you're 25 years old, in general, a standard way to think about that graph is it's probably going to look like some sort of bell curve, right? You're going to start early on, maybe in lower tax bracket. As your earning power increases and then you hit the prime of your career, you hit peak earnings years sometime mid-late career, and then you retire and your income comes back down. And so, real big picture, that's how I would think about it. So I would say wherever you're at in life today, we want to play that graph out in our heads as long as possible. And if we're looking today and we see climbing income in the future, we might say, okay, how can we increase taxable income today that might decrease taxable income in the future? If we're looking today and we're seeing that you're going to have lower taxable income in the future, we might say, okay, we need to try to get this down today, take a few more deductions if we can, because we want to pay tax when we're in a lower bracket. And then, of course, if we're level, we're looking for other strategies. So that big picture, that's how I would think about it.
This question might kind of dovetail with what's going on. Obviously, this might open a Pandora's box, but there's obviously the current government administration has a proposal on the table for some tax changes. So how much do you take that into consideration? Like you said earlier, like we're currently in a spot where taxes are favorable, over, historical average, that they're more favorable than average. Do you take that into consideration when doing this kind of planning?
I think that's more of a tiebreaker consideration if all else is equal. So if all else is equal and we're trying to make a decision about a tax planning strategy, that could be a tiebreaker. And what I mean by that is if there's no other obvious lever that leads us down the path of a decision, we might say, hey, we don't know how else to base this decision. It's kind of a toss-up, but right now, historically speaking, tax rates are pretty good. So let's go ahead and push through some income, something like that. So I look at it as more of a tiebreaker because we really have obviously no idea where that's going to go. I don't think anyone in Washington, D.C. has any idea where that's going to go either between now and the end of the year. But the one comment I will also add on to that is the current tax proposals that are on the table are going to directly affect very, very, very few people. And this is a tongue-in-cheek comment, but sadly, it rings true to some degree. What I say is if your income or net worth is the same or less than the average United States congressperson, you don't really have much to worry about. And that's a tongue-in-cheek comment, but if we look at the numbers, it actually plays out to be true. So you can take that wherever you want to, but I would say in general, the current policy we see, and Lyle, you and I have looked at it, the team's reviewed, the proposals that are on the table, just in proposed form. Again, who knows if they're going to get anything through or what parts of it they could or couldn't get through. But what we've seen, very little effect on anyone, and certainly if you're making under $450,000, and if your net worth below $10 million, you probably aren't going to see any direct effect.
Mm-hmm. Good.
Yep. Good. So just jumping into some common tax planning strategies, and I'm going to go through these really quickly, but I would say if you're listening to this and your mind's turning, or you're wondering, hey, what applies to me here? Or should I be thinking about that? Immediately when this webinar is over, send your advisor at Masters an email, or if you're not a client of ours, still send us an email, and we'll be happy to help work through any questions you may have or any thoughts you may have about, should I be thinking about doing any of these things? So I'm going to start with retirement accounts. And so retirement accounts, 401ks, IRAs, Roth IRAs, if you're self-employed, maybe you have a SEP IRA or a solo 401k. All of those types of accounts come with some sort of tax benefit. What you have to understand about that tax benefit is you're trading a benefit for something else later on. The IRS does not hand out free money. Everything they give you has some sort of string attached to it. And so we really need to think about how do we optimize the use of retirement accounts. And so one real basic thing is to look at, should I be funding my retirement accounts today if I'm working with pre-tax dollars? If I'm funding with pre-tax dollars, I'm getting a deduction today, and I'm not paying tax until that money comes out when I'm retired. Or do I want to fund that with after-tax or Roth dollars, as they're usually called? And that means I'm getting no tax break today, but all of my earnings will grow tax-free as long as I don't pull them out in a way that the IRS doesn't allow me to. And so that's a really impactful decision. It's one that most of us have to make. And it's one, Lyle, that I think needs to be reviewed every single year. I think you would agree on that. And so that's something that we want to continually look at, pre-tax or after-tax for funding retirement accounts. I talked a little bit about Roth conversions, or at least mentioned it. This could be applicable really anywhere you are in the life cycle, but I would say it is most applicable to those of you who are retired from your full-time job, and especially those of you who are retired from your full-time job but have not turned 72 yet. 72 is a magic number because, again, IRS doesn't give you anything without strings attached. If you have pre-tax dollars, pre-tax IRA or 401k dollars, then in most cases when you turn 72, the IRS makes you pull a stipulated amount of money out of those accounts every single year. They need to get paid eventually, I guess, would be their philosophy. And so sometimes in between that time frame can be really good times to move money from pre-tax to after-tax Roth, pay tax if you're in a lower tax bracket, and then leverage the advantage of tax-free growth in the Roth IRA. and Roth IRA dollars are not subject to RMDs. And Roth IRAs are probably the most friendly asset to pass on to the next generation. So especially if you're thinking, I want to leave some money to my family, that's a strategy that is definitely worth considering. It's also worth considering, especially if you're younger and you're still kind of climbing that curve of income. It can make a lot of sense to look at Roth conversions at that point as well. And then the one other time where it could really make sense is if you own your own business and you are having not as good a year in business, and that makes your taxable income lower, that could be a great opportunity to look at something like doing Roth conversions. And then the last one I have on here is only relevant if you're age 70 and a half or older. Who comes up with these ages? I don't know, but they pick 70 and a half. If you're 70 and a half or older, you can take IRA dollars that normally you take out and pay tax on and send them directly to a charity, and no dime of taxes is paid. And so if you're over 70 and a half and we haven't talked with you about qualified charitable distributions or QCDs, send us an email right after this presentation and we'll make sure we look at that for you. Business income. If you own a business, there's a lot more complexity in your tax situation. In general, with business accounting, it's not as simple as what did you make, what were your expenses, here's your bottom line. There's a lot of things that go into the accounting that's going to lead to what tax are you actually paying, especially if you're a pass-through entity. So if you're an S Corp, if you're an LLC, that's pass-through. Anything that happens in the business is going to end up on your tax return. So how can you manage those decisions at year end? And just two things to think about, and these are two areas where it's especially important to have a qualified CPA in the mix, helping make these decisions, are one, managing depreciation. So if you have hard assets that you're allowed to depreciate, how do you manage that depreciation year over year? You have a little bit of wiggle room with how you do that, and ideally, you want to take more depreciation in high income years, less depreciation in lower income years. And then also looking at capital purchases, because those are the assets you can depreciate. So again, if you need to make some capital purchases, spend some money to reinvest in your business, and you're having a really high income year, you might want to make those purchases in December rather than January, and maybe you can find some more depreciation to deduct for the year. So there's a lot more in that bucket, but for the sake of time, I kept it fairly simple here for today if you own a business. And again, if you're out there, you own a business and you're not sure about what these decisions look like at year end, let us know and we'll coordinate with you on that. And of course, get your CPA involved. Passive activities. So if you own rental real estate, if you have outside, say, private investments, there's some things to be aware of there. There's some rules around passive activity losses that you have to be aware of. Generally speaking, you can only take passive activity losses on your tax return if you have passive activity income. There's some exceptions to that, but you really have to be cognizant of that if you have investment strategies, not in retirement accounts, that you are not materially involved in. And typically what we see at Masters, that's usually real estate or other private investments. You put a sum of money into someone's business or something like that. And if you own rental real estate, there's also a lot of different things that can affect the tax liability on that real estate. Depreciation is one of them. Repairs on the property, travel to and from, any professional fees you pay. So just make sure you're taking advantage of all the deductions. That is one of the advantages of an investment such as rental real estate, is you can lower your tax liability during the time that you have the investment. You do have to be aware, though, that when you dispose of that investment, all that depreciation you took, you got to pay it back. So those are just some things to be aware of. But again, if you have those sorts of investments and you're wondering if there's anything you should be aware of, or you want to make sure you're getting all the deductions that you should, send us an email, and again, we'll coordinate that with your tax preparer or CPA. And then we're about to dive into conversation about giving, but I just want to touch on it here. Of course, charitable giving, I would say, is the most common lever we can pull to reduce taxable income. Most of you out there do some sort of charitable giving, and we don't give, as I'll touch on later, we don't give for tax deductions. We give because we want to give. But if we're giving, let's leverage it in the best way that we can. That would be our philosophy at Masters. That could be through the use of a donor advised fund, which is essentially a giving fund. You put money in the donor advised fund, you get a deduction in the year that you put money in, but you can disperse those assets at any time to qualified charities. And another strategy that has a little more to it, and I'm not going to go through the details today, but if it piques your interest, let us know, is a charitable bunching strategy. And what that strategy is because the standard deduction is now higher, you remember we looked at the standard deduction, $24,800, and because your itemized deductions are now limited, you might have a standard deduction of $24,800, and let's just say you add up all your itemized deductions and they're $20,000. They're below that line. That means that you're not going to get any benefit for your itemized deductions. You're just going to take the standard. And so what charitable bunching is if a decent portion of your potential itemized deductions is charitable giving, we can do 2 years of your charitable giving. So let's say you want to do $15,000 a year charitable giving. What we could do is give $30,000 either through a donor advised fund or directly to charity in one tax year, allowing you to itemize your deductions, go beyond the standard deduction. And then the next year, you don't do any giving in that tax year, but you still get the standard deduction. So instead of taking the standard deduction both years, 1 year you itemized, another year you still took the standard, and combined, you were able to get more deductions. So I breezed through that one, but if that piques your interest, let us know, and we'll look at if that makes sense for you in your situation. So Lyle, that was a quick run through. Any questions coming up on any of these strategies in particular, or anything along these lines?
I don't have any current questions on taxes or anything. Just a reminder to everyone, if you do have a question, I'm monitoring the chat and the question box, so feel free to type anything in there. I'll get it, and then we can discuss it from there. So just a reminder on that.
Great. Well, I think we've done enough taxes for one webinar, so let's move on to our last topic today, which is looking at giving, and we just call it in general the topic of generosity. Just like we talked about up front in this webinar, we think it's really important for you to have a giving philosophy. And that doesn't need to be fancy. It doesn't need to have big words and be up on your kitchen wall. But in general, you want to have some sort of framework to help you consistently make good, intentional giving decisions. I said this earlier, but our philosophy is you give because you want to give. You don't give solely for tax benefits. But tax benefits are one of the positives of charitable giving, especially significant charitable giving. And so these are just some things we want you to think about, and we're happy to talk through with you as you're trying to put together some sort of giving philosophy. And the first thing is, how do you come up with an amount? I would say if you're working, obviously the standard and most easy way is just to take a percentage of your income that you give each year. You could also use a bucketing strategy where you want to give a certain amount of dollars in the year, but some of it you give as regular giving, and other giving you essentially reserve throughout the year to maybe give larger gifts or one-time gifts when those opportunities come up. And then another question you want to answer is, do you want to have a variable giving level based on income or assets or investment performance, or do you want to make sure you give the same amount of money every single year? And that might vary organization to organization, but that's a good thing to think about big picture as well, especially if you have declining income years. If you're basing your giving on income and your income's down for whatever reason, you want to make sure you decide ahead of time, how am I going to handle that? Am I going to use a percentage of income, or am I going to find a way to land on a flat number so I don't decrease giving? And those are personal decisions that we're happy to help walk through with you. But again, that comes back to what is most important to you and what feels most comfortable to you. Of course, there's various types of assets. Are you going to give cash? Are you going to give securities? We don't want to give securities that are in retirement accounts unless we're doing it through qualified charitable distributions. But certainly if you have non-retirement investment accounts, it can be beneficial to give securities as opposed to give cash. There's some things you need to be aware of there and some limitations. But if that's not something you've thought about before or considered before, let us know and we can talk you through that. And then of course, goods. You have goods in your home that you give away, you can deduct those if you itemize your taxes. And so how are you going to handle those various forms of giving? And not all giving is deductible. So how do you want to think about your giving philosophy when it comes to, I say, deductible versus non-deductible in the context of taxes? Maybe you want to give X amount of dollars that you know is deductible giving, but you reserve some dollars as well to just give to those in need around you, give to family who needs it, give to people in your community, in your church that need help. And I think sometimes we think too much about just giving to organizations when there could be individuals or families that we're close to, we have a relationship with, that we could give to in various ways. It doesn't always mean cutting them a check, but how are you going to do that and work that into your philosophy? And then strategy, I touched on some of these, but for some of us, an autopilot strategy is best. At the beginning of the year, we decide this is what we're going to give. We're going to do it monthly or quarterly. We're going to set those up automatic. And that way I know that when December 31 comes, I gave the way I wanted to. Some of us are going to want to do some of our giving that way, but leave some room throughout the year to do some opportunistic giving. And then some of us might want to keep our giving down a little bit in the early part of the year so that we can give larger gifts at the end of the year if we feel like that's what we're being called to. There's a lot of different ways to slice and dice this. It needs to be personal to you, and we, of course, can help you work through that. This is more from an academic perspective, but just to get you thinking about some of the types of giving that we all do. Relational giving, that's the giving we do because we know somebody. Maybe we're not necessarily tied into the purpose of an organization. Not that it's bad, but it might not be something we're specifically connected to, but we're good friends with the executive director and we want to support them that way. That would be relational giving. There's reactive giving. So the easiest example I can think of this is I can't say no to the kids. When anyone comes and knocks on our door and they're selling especially some sort of food item, you better believe that I'm forking over whatever I need to for 2, 3, 4, 5 boxes of Girl Scout cookies or a 48 pack of Boy Scout popcorn, whatever's being sold that day. And that's reactive giving. We're just giving on the spot. Maybe we're at a charity banquet and they're asking you to make a gift there. And we just want to think about how are we going to handle those opportunities when they come up. My personal philosophy, as I said earlier, is I don't say no to the kids. So if you got kids and grandkids that need to get their sales up, send them over to my house. Lyle will probably send out my address in the chat. Grassroots giving is an interesting philosophy, and we think about that as community-based giving. And that's focused on ideas in a more localized setting. So maybe that's something in your neighborhood. Maybe in your neighborhood there's a park that wants to be developed or a common area, or you have homelessness or people in need somewhere in your community, and you do giving to address those needs. And that giving is usually community-based. You rally around a group of people there that's localized, and you're looking to just try some ideas to help whatever you see locally. You're focused more on ideas than you are on results in that standpoint of things. But I think that's a really interesting concept and something kind of unique. And then I love this term, peanut butter philanthropy. That was an academic term that is used for spreading out your giving amongst many different organizations. You're spreading it thin, just like the peanut butter on the sandwich. And that may be the way that you want to do it, or you may want to go the other way and say, instead of giving a little bit to 20 or 30 different charities, we want to give a lot to 3 or 5. And that's something to think about as well. What is your philosophy going to be as far as a lot of different relationships, a lot of different charities, or just a select few that you really want to seed into? Really difficult thing with giving, and again, we just encourage you to think about. We're not necessarily talking about putting together a 10-page business plan for giving, but just to think about how can we make sure we're being intentional about it. These are just some questions we think about. How do you define success? Is it going to be in stories? Is it going to be in impact? Is it going to be seen through specific organizations that you support? How are you going to interact with those organizations? Are you going to follow their newsletter? Are you going to go to all their events? Are you going to serve in an area that they serve in? How are you going to interact and stay connected to the organizations you support? Who's going to take responsibility for the results, or does there need to be responsibility taken for the results? Ultimately, you're your own judge in this. And so just thinking about how are you going to measure success? Are you going to be focused on results? Or are you simply going to be led by what you feel called to and allow the rest to work itself out? I think any of those philosophies can work. It really just depends on your personal preference. And then how are you going to continually reassess and re-examine? Of course, with Masters, we're planners, so we always encourage you to reassess, re-examine, and make sure that your philosophy stays consistent with what's most important to you, because that can change over time. So Lyle, I'm just going to jump right into these conclusions, and then we'll take any more questions.
Okay.
So to wrap this all up today, we're encouraging you to think about pre-planning your decision-making process. Build a very simple framework for decision-making so that when decisions come up, you can quickly filter them through to a well-balanced ending point. Know your values and your goals. Know what's most important to you, know what you want to achieve, and make sure that what you're doing today are aligned with those things. Again, something that we'd be happy and, in fact, privileged and honored to help you with on an ongoing basis. Optimize your tax situation by taking a multi-year planning approach. And this is how we do it at Masters. Partner with us to help you do this, but think about taxes and more than just what's happening here this year in 2021. Understand the basis of the tax code and how your situation fits into that. Do you know what your effective tax rate is versus what your marginal tax rate is? Your marginal tax rate is what bracket do you fall in with your total income. Effective is how much total tax you actually paying off your adjusted gross income. And a lot of different things can factor into that equation. So understand where you are in the tax code so you can figure out where to optimize it. And then on the giving front, create a philosophy that's personal to you. This doesn't need to be fancy. This doesn't need to be sophisticated. It needs to be something that works for you and is personal to what is most important to you, is sustainable over time, and has at least something that you can check yourself on, that you can hold yourself accountable to. And giving accountability might be even too strong of a word, but just some way to be able to revisit and make sure that you're aligned with that philosophy. And so with that, Lyle, let's move into a few questions. We've got a little bit of time here to take some more.
I was when you were going through the presentation on generosity, the peanut butter philosophy kind of jumped out at me, and I can identify with it. It seems like there's a lot of needs out there, and then especially when people get to know that you're generous, there's a lot of people knocking on your door and sending you mailers to ask for money. So it can be really easy, I think, without too much, if you're not intentional, it can be really easy to start giving a little money here, a little money there, and get yourself spread pretty thin. What's your thoughts about, if that's what you find yourself in, that you're giving money to a whole bunch of different places, but not really anything super impactful in any one area? What's your thoughts about trying to shift that? How do you start trying to shift away from a peanut butter philosophy?
Yeah, that's a great question. I would do two things. The first thing I would do is re-examine what is most important to me. What am I most passionate about? What do I feel like I'm being called to impact?
Hmm.
And the what is what types of charities do I want to align myself that are solving problems that are personal to me or that I feel like I'm called to be involved with. And that could be any of the myriad of problems that we face here in our society. So I would start there. I would start with what are the problems that resonate most with me, that I feel most pulled to and called to be a part of a solution to. And that at least gives you some framework to filter. And so then I would take that framework, and maybe you've listed two, three, four, probably five at the most different issues that you came up with that are personal to you. And I would just go through your list and I would filter through that and say, are all these charities aligned in one of these buckets? If they're not, maybe I need to stop giving to them. If they are, I group them into different buckets and say, okay, are these all doing a good job? Not all nonprofits are created equal. Some are run really well, some maybe not so much. And I think we want to be intentional about aligning ourselves with the organizations that are really focused on having impact in the areas that are most personal or that we have the most connection to. And so that's what I would do. I would think about those categories and I would filter through all the charities and I would knock anything out that doesn't filter back up through one of those choices that I made. And then I would even kind of parse through the ones in the same category, say, am I really confident? And do I really feel like I'm behind these particular ones? And maybe you scratch off one or two. But I want to say also, Lyle, I don't think the spread it thin mentality is always bad. I think for some of us, we want to give to everything and anything. We might not have really specific different areas that we're called to, but we might feel like, I'm just called to give in all the places that I'm asked to give in. And I think that's okay as long as it's intentional.
Right. Good. Yeah, thanks. That's helpful. As of now, Gary, there's no more questions here, so I think that kind of wraps us up.
Great. Well, we really appreciate everyone taking time out of your day to join us today. If you have any questions as follow-up to this webinar, please email us at Masters, email myself, Lyle, your advisor, anyone else here on the team. If there's anything here that you're thinking, maybe I should think about that or do that, let us know that. We've got plenty of time here at the year end. We are deep into year end planning. It's a lot of fun. We're nerds. We enjoy this stuff. And so if there's anything we can be doing for you, helping you with here as we come to the end of the year, please let us know. And with that, everyone have a great evening. And thanks again for joining us and for your trust in our team at Masters.